So good afternoon, everyone, and welcome. I'm Jan Schweiner. I'm a Richard and Gardner Professor of Economics and International Affairs here, and Director of the Center on Global Economy and Governance. And it's really my pleasure to welcome you to the 2024th Annual Conference on EU-US Competitiveness, with a focus today on the challenges associated with a number of things, including the green and digital transitions. So we're honored this year to host this conference as part of the Ambassador and Vera Blinken lecture series, and in memory of the late Ambassador Donald Blinken, who with his wife Vera, who is here with us, joined us. It's wonderful. Generously sponsored the university-wide lecture series since 2015, bringing remarkable speakers to Colombia to discuss public and foreign policy issues. I will move here on that note. Often with European focus, in fact, we have a little memento for Vera commemorating all the lectures. Let me just quickly read. So 2015, Wolfgang Schäuble, then German's Minister of Finance. 2016, Pierre Carlo Padoan, Minister of Finance of Italy. 17, Werner Hoyer, President of the European Investment Bank. 2018, Ambassador Daniel Fried, Distinguished Fellow of the Atlantic Council. 2019, President Antonio Tajani of the European Parliament. 2019, Jens Stoltenberg, NATO Secretary General. 2021, Jane Harman, former U.S. Representative for California, 36th Congressional District. 22, now we had the Anthony L. Gardner, Managing Partner, Private Equity at Brookfield, former U.S. Ambassador to the European Union. And today we have our annual conference relating to EU-US Competitiveness, which we are dedicating to Donald Blinken. So I'll hand this over to you. Our search. We have to take it. Yeah, here. And we will mail it, so you don't have to carry it. All right. So without much ado, there is, there's a number of ways we could start, but we thought we would ask Rich Clarida, who unfortunately got stuck in Midtown, but is joining us. Rich, thank you very much that you're overcoming the obstacles. If you could give us some introductory remarks from the U.S. side, and then we'll go on and bring in others.
Well, thank you, and I do apologize for not being there in person, but Chair Powell is just offering public comments today, and so I'm having to address some of that as well. I'm really looking forward to this because I'm going to be learning a lot today. The focus of this session is not something which, frankly, that I myself have focused on, but I do have a couple of thoughts from a macro perspective that I think are quite relevant to the U.S., maybe less relevant to our European colleagues. And if anything, I'm going to emphasize some points that I think have maybe not been emphasized sufficiently about. In particular, I'll be focusing on fiscal priorities to support the climate transition, related to some extent to some priorities for competitiveness, and in particular some of the macroeconomic possibilities that may emerge from this. And let me just stipulate at the outset that I'm not going to be opining or weighing in on value or cost benefit of all this. Indeed, when it comes to climate, I think those calculations are hard to do. But more narrowly, just focus on the state of play as I see it macroeconomically in Europe. So we've had several pieces of legislation under the Biden administration, the CHIPS Act, elements in the interestingly named Inflation Reduction Act, which are really more about government policy to facilitate and subsidize climate, green transition. and then a separate piece of legislation on infrastructure. And I guess what I would say macroeconomically is that this legislation is now beginning to be dispersed into the economy, through subsidies and other means in a U.S. economy that is either at or perhaps somewhat beyond maximum employment, and in a U.S. economy in which, although inflation has come down, it is still higher than the Fed's target, and if anything, is proving to be more sticky and stubborn than I think the Fed was hoping a couple of months ago. So what that simply means is that in the aggregate, this, at least for the next 3 to 5 years, and we can maybe at the end, I'll talk about longer term payoffs in terms of productivity, but at least in the aggregate for the next 3 to 5 years, this is not really going to, it's not, there's not any slack or there's not any output gap to fill. So these funds are coming into a fully employed economy at potential. So it's going to reallocate resources, but it's not necessarily going to grow the pie, which of course is the point, which is the policy wants to reallocate resources, in particular, either towards facilitating the green transition, or in the case of some of the industrial and trade policies to move away from an offshoring model to a friend shoring or a near shoring model. But it's ultimately going to be allocative. It's not going to increase the size of the pie, and I think that's relevant. It could. The numbers I've seen and that I respect, that I've not generated myself, so I respect them, indicate that probably for 2024 and even 2025, the macroeconomic consequences of this, may not be huge, but at the margin, they're going to put upward pressure on inflation, and in particular, a lot of efforts not originating with the public sector, but with the private sector, without any government prodding, want to have supply chains that are more robust and less vulnerable to frictions with China. So that's happening anyway, but almost by definition, that's going to have to raise the cost structure, because otherwise, if it was lower cost for supply chains to not rely on China, companies would have done that. So both those efforts, as well as some of the other priorities, I think at the time that this was being discussed, maybe in 2021, it looked as though the economy might be operating, below potential. But I don't think that's the case now. The second point I'll make, which is related to the first, is there's been a lot of talk among some macroeconomists I respect, that these efforts that I mentioned, the Infrastructure Act, the CHIPS Act, and the Inflation Reduction Act, are going to put substantial upward pressure on interest rates, and I think the case for that is not, that could happen. But the case for that is not clear cut. I think we know the direction, but the magnitude may not be all that big. And here's why. A lot of the purpose of these policies is to encourage investments in alternatives to the way they would have been invested prior. The classic case would be if you encourage auto companies to go electric, then they'll be building battery plants and not engine plants. So they're allocating investment differently, but they're not necessarily spending more dollars on total CapEx. It's just different CapEx. Now, when it comes to the infrastructure piece, that's clearly incremental. Companies typically don't do infrastructure. That's a public good. But for the other pieces, I don't think it's clear that it's necessarily something the Fed would need to worry about, is putting upward pressure on rates. I think that So I think maybe the final thing I'll say there, and this is something that others in the room, perhaps including Sharon, will have a view on. I was just in Frankfurt about 3 weeks ago. I was speaking at an ECB Watchers conference, but I saw a lot of folks on the sidelines. And one thing everyone was interested in was how much of the Biden legislative priorities would remain, in the case in which there's a Trump victory. And I think the details there are important. But every White House has some discretion over how legislation is translated into action. But what's interesting in some of the work I've seen is that, talk is cheap in politics and in economics, but there are a lot of provisions of those bills that passed under President Biden and with Democratic support that actually a lot of Republicans like as well. So there might be less change than some people might expect. But I think I'll leave it at that, and then look forward to participating, as a backbencher during the rest of the session. Thank you.
Thank you very much, Rich. Just to add for everybody's erudition, Rich is the C. Lowell Harris Professor of Economics and Professor of International and Public Affairs here at Columbia, and of course, until recently, Vice Chair of the Fed. So we thought we would go with sort of the more macro aspects first, and then get to the structural micro things. So I'll ask Boris Vujčić, Governor of the Central Bank of Croatia and long-term attendee of our events, and we reciprocate with him in Dubrovnik when we can, to take the floor next. Boris, I'm glad to give you a microphone.
Yeah. Thank you. Thank you, Jan. Pleasure to be here again in such a distinguished company. And let me say my few words to start with on the European competitiveness. We have been recently under a lot of I would say, pressure in Europe, particularly after the energy shock crisis, after the Russian invasion on Ukraine. Europe is overall much more energy dependent than the US or China, as you know. So the terms of trade shock for Europe was much stronger than for the US or China. Now the things have improved as energy prices stabilized, but the problem is still there because the energy in Europe is 2 to 3 times more expensive than it is in US, for example, which creates an environment in which the energy intensive sectors are still at a disadvantage in Europe. One might say that they have been at a disadvantage even before because the energy prices were higher in Europe even before the energy shock. It's only that the energy shock made them more obvious to everyone. And maybe some companies in Europe are now deciding to reallocate from Europe on the pretext of the energy shock. Well, they were contemplating about these possibilities even before. And this is something that we are actually already seeing, and we might see more of that. Then with the IRA and the subsidies offered by the U.S. government, there might be other industries also deciding to locate their production in the U.S. That's another problem that we might see and actually are already seeing in some of the cases. And Europe is now, of course, thinking about the adequate response to that. It has not been yet tabled, but soon we will probably have some. There are also the legislative actions in Europe in order to incentivize the demand for the green eligible technologies, probably not the demand side, but Some countries individually already doing also subsidy policies as a response to what they've seen is happening. In terms of the probably most important single export sector in Europe, it is the car manufacturing. There is another set of challenges coming from China in terms of the EVs, electrical vehicles. And we'll have to see what will happen there. We might see protectionism in that area very soon. As you know, the Scholz has just went to China to convey the message on how the Europeans think about it and how they might respond to the Chinese subsidies, to not only that but a few other sectors. And the ICT sector overall, which is the fastest growing, obviously, industry, with the magnificent 7 companies in the US beating all capitalization records at the rates which we've never seen before. Europe does not have any of the top ICT companies, although the ICT sector is not that weak in Europe. But if you look at the companies that tried to compete, for example, in the mobile devices, like Nokia, Siemens, Ericsson, they basically all lost. They're out of that sector and have lost their battle. Then if you look at the universities, also things don't look very, very well. If you look at the Times ranking of the university for 2023, out of the top 20, only 4 are European, and none of them are in the EU. 3 are in the UK, and 1 is in Switzerland. So that's also not very good for the long-term competitiveness, particularly for an area which relies on a high-end manufacturing of the consumer goods in particular, and machinery. Okay, but having said that, Europe is still very strong in manufacturing of the machinery, of the consumer goods, and of the cars. If you look at the share in the EVs, actually Europe's share is rising over the last 5 years. And the American is shrinking. So European and Chinese are growing, and actually European is growing even more faster than the Chinese. So let's see how that all ends up. Probably the Europeans, when car manufacturing sector is not the one not to be underestimated, given its history, its abilities, and the engineering capabilities. Okay, let me stop.
That's perfect. No, thank you very much, Boris. We have been particularly fortunate at Columbia that we attracted a colleague that came to us this last year. It's Alan Taylor, who is sitting right here. And Alan, would you be so kind as to give us a little bit of overview of some of the global trade, financial issues, or whatever else you'd like to
Sure. Thank you. And I thought both Rich and Boris did a good job of saying some of the things I would have said, but I'll try and inject some new thoughts. At the global level, I mean, one thinks of these challenges as problems of collective action with externalities and spillovers. So the natural thing as an economist is to wonder where coordination should go, and why isn't it already happening, perhaps on a scale that you would expect to meet some of these challenges. It wasn't there 5 years ago or 10 years ago, but the problems seem to be more front of mind. But of course, one has to make allowance for the fact that the last 4 or 5 years have seen so many other things for policymakers to worry about that maybe that explains slow progress. In terms of US-EU, it feels like there have been a lot of conversations about trade, right? And competitiveness is very tightly linked to that. And it also links into the agenda and the concerns about resilience and supply chains. So I feel like one gets into repeated conversations with both US and EU counterparts where the question is how can that trade between the two blocks become a substitute for the alternative trade with other supply chain linkages that might be less resilient in difficult times. So it feels like that's low-hanging fruit, but nothing is really happening there. And this is in a context where already the WTO is sort of stuck in neutral or reverse or whatever car crash analogy you want, leaving open the possibility for some bilateral work on that. Now, that may play out very differently under Trump versus Biden, but it's not as if there's been great progress under either. But I think in terms of security and supply chain resilience, the Europeans and Americans have a lot to think about and work on in that respect. So I'm not expecting a trade deal overnight, but I would think some conversation about, why we both reinventing the wheel. At least we could collectively, share the wheel reinventions that we need to do to make the particular sectors or technologies that we have more resilient, less exposed to geopolitical risks. I completely agreed with Rich's comments on inflation versus interest rates. I mean, when you look at the total investment amounts that are hypothesized under the acts that were passed, or even maybe whatever shifts you see in private sector investment, it's very hard to add those up and get really big numbers. As Rich said, a lot of this is switching from doing brown investment to green investment. And whether on net that will drive up the demand for credit, for savings, will investment savings balance change fundamentally in the medium term? I don't think that's so easy to predict, but the standard errors are probably large on those estimates. The final thing that kind of is always a kind of friction and a contrast between what's happening on the EU side versus the US side is the way in which policy is implemented through taxes and subsidies and the overall kind of financial under picture of that. And, Biden has passed very big bills with very big price tags, at least in the short run. And then the EU, despite several mooted Hamiltonian moments, hasn't gone full Hamilton in the US sense. But the challenges are just as large on the EU side. And I just wondered if that's going to come into play a little bit more in the years ahead. So, when you think of both COVID and the energy shock, I mean, a lot of the response to the energy shock was to sort of suddenly wheel into operation contingency plans, often very rapidly made, to reactivate whatever nuclear power plants you thought shouldn't have been operating the year before, or to build new storage for gas or oil so that you weren't running on a very thin margin of reserves. And so there was, infrastructure needed there to, put storage places into the line. So it would be interesting to know if there are going to be more thoughts along that dimension, and it applies to green as well. Are you going to rely on solar and wind, or what happens when the sun don't shine and the wind don't blow? Are you going to think big about hydro and nuclear, which I think is probably where we all have to end up in the medium to long term, because that's where you will get P green lower than P brown, which is ultimately what will convince people to switch, not the nudges that are being tried at the moment. And it will also lead to more resilience. So I'm kind of curious to know whether we'll get more of a Hamiltonian shift, when and if the EU can A, think about those strategies, and B, fund them.
Thank you very much. Well, we have enough EU people here to get the answer this afternoon. So let me ask Patricia Trish Moser to go next. Trish, as you know, is senior research scholar. She's director of the MPA in Economic and Policy Management program and has a very rich experience, both academic and at the Fed. So it's wonderful to have you here, Trish. Thanks.
Thank you. Thank you, Jan. I'm going to change gears a little bit, but I do want to agree with the several points that have been made about the U.S. in particular, where it is in the cycle and inflation pressures. I have been a relative hawk on this topic for a while, and not to mention higher for longer. I think the risk, frankly, on the other side of this is that given the size, have a 7% fiscal deficit and a growing economy, as Rich pointed out, there's a whole other big financial stability macro risk sitting out here, which is R gets too far above G for too long in the United States, and it's not a pretty picture. Even for the exorbitant privilege doesn't get you out of that problem. So that's my one macro comment. Now I want to kind of shift gears, since digitalization was in the title, I'm actually want to talk about digitalization. I'm going to talk mostly about finance, since that's what I know the best. Obviously, the pace at which innovation is going to happen in the coming years, it's already been incredibly fast the last 5 years. It's going to accelerate even more. And it's going to happen, like all financial innovation to do, with the private sector leading and the public sector coming up behind, standard setting, regulation, and so forth, defining what money is in a digital world, for example, at least what sovereign money is. What worries me a bit is that that's not happening fast enough in the public sector. And not just that it's increasingly happening outside the regulatory perimeter where we don't see so well. Maybe even more worrisome in some cases is a lot of it's happening outside the legal constructs and the privacy constraints that the people in this room think of as normal, but are really only the base case in representative democracies. And finance is a global industry. There's absolutely no question about it. It's as global as any industry you can imagine. So I am concerned the public sector is not stepping up fast enough, and what that's going to mean for stability, not to mention efficiency. And let me be specific and make a second point, which is that if we really want to get the benefits of digitalization globally, which are efficiency and speed and lower risk, lower cost, financial inclusion, those are things for the financial inclusion slightly less than the others, but those are things that are going to benefit greatly from global standards and global cooperation and coordination. Now, the financial regulators and the central banks have done a decent job, not great, better than the WTO, in the last few decades on that front. But I think they need to step it up. The international monetary system needs fixing, and the only way that's going to happen is everybody decides on a set of standards. There's work being done on that. I'm just worried it's not happening fast enough. Last point I want to make about digitalization is speed. The only truly new thing that we've learned in the last year, particularly about the bank failures last year, is that technology has fundamentally changed the nature of payment flows. The combination of fast and instantaneous payments, along with instant communication, pick your medium, social media, anything else. That means that runs, whether they're happening from bank deposits or customer accounts or international capital flows, happen in minutes and hours and 9 days. The statistics for the U.S. are really interesting here. Worst bank failure, worst run in the United States prior to this was Lowell during a global financial crisis. Something like 5 or 6 on its worst day, 5 or 6% of its deposits flowed out. The fastest run before that was Continental Illinois. The wholesale bank went broke in the mid-1980s and had no deposit insurance at all because it was a wholesale bank. Worst day was 10%. 40% of SVB's deposits ran in 3 hours. Credit Suisse's customer accounts, not deposits, so it wasn't a bank run, ran not quite that fast, but pretty fast. Much faster than anybody would have anticipated. And what happened last March is not specific to the U.S. Or Switzerland, certainly for that matter. It's about the nature of funding flows and capital flows. I'll be blunt. It should be a huge wake-up call. The financial services industry is not ready to handle this. The public sector is not ready to handle it. And I think everybody start thinking about it. Okay, now I'll stop.
Well, thank you. That's a wake-up call. I agree. Now, let me check. Do we have Isabel Vansteenkiste here up there or not? Isabel, can you give us your remarks? Yes.
Yes. Can you hear me?
And we can see you and hear you. Right.
Okay. Yeah, I was switching off my camera when I was not talking because I'm on the IMF network and somehow it seems we're getting overloaded because more and more people are trying to connect here. Thank you very much, first of all, for having me. And in my remarks, I'm going to be more European focused. I'm going to talk about the same topic that Boris already tackled, is the competitiveness challenges for Europe. And I'm going to circle it around old, new, but also talk about something borrowed and something new. Yeah, so just to say, I mean, there's a lot being said and done these days on competitiveness in Europe. But if you look back, it's not a new problem in a way, right? So ever since the mid-90s, I think we've been talking about the gap in terms of widening, especially between the US and Europe, for instance, on productivity, which is one proxy you can look at when you talk about competitiveness. And if you look at the sectors that has been problematic, it's been ICT sectors and market services, right? And it's a lot related to the slow adoption of innovation, lack of investments, lack of R&D. And so basically, when we're talking about these issues today, it's basically, more of the same. But there is a reason to look at it again in a way, because there's also new challenges, right? And this is part of the title of the workshop, right, where we talk about the digital and green transition, right? So we're having more global challenges as well. And what is added to that, which was not in the title, is basically the geopolitical fragmentation of the world becoming more transactional. And if you take that together, more global challenges and at the same time more risk of fragmentation, what you're more likely going to have is more frequent shocks, right? Frequent cross-border shocks. You may also be affecting each other still because some of the challenges and impacts may be global. What we see already in Europe in practice is higher and more volatile energy prices, right? And this is already a clear effect of that. What we also see is a clean energy race happening across the globe, right? And of course, some in Europe look at the IRA, but even more important maybe is what is China also doing in that regard. And if you think about the digitalization, at least from a European perspective, it comes back to the old problem all over again, right? Are we going to be able to embrace AI, or are we just going to be regulating it, right? And so are we going to have the benefits, or are we only going to regulate it? That's really a big question. Now, in terms of the policy response, I guess, at least from the European side, the old prescriptions actually become even more relevant. Some of the structural reforms to make sure that you can bounce back better from shocks become more relevant. Reducing bureaucracy, red tape, but also the single markets, right? Basically leveraging on your market size. Capital Markets Union having the ability to finance the transitions will be important. But also the new elements come in, right? And that comes also with some new kind of policy messages, like importance of resilience, right? I mean, and sometimes some people see a trade-off between competitiveness and resilience, but in some cases they can go hand in hand. And at least having this thinking of strategic autonomy and, for instance, on energy independence is important. And then finally, I wanted to come to the borrowed and blue. So blue being here from the European flag. And the borrowed aspect, because you have more need for public goods. You have more common goods needs, and that of course would put at the center, especially in Europe, the need for kind of a fiscal capacity, at least that can deal with the provision of these public goods, because at least when you do it jointly, you're more likely to be able to provide these goods. So I think that's kind of the take I had when I saw the title of the workshop today and what you wanted to discuss and how kind of the European perspective would be for me in that regard. Thank you.
Thank you very much, Isabel. I just should have added right at the start. Isabel is Director General at the European Central Bank, so hence the European perspective. And speaking of banks in Europe, Deborah Voltella is the Chief Economist and Director of Research at the European Investment Bank. She's the co-chair of this with me, so I will let her speak as a speaker, and then whenever you want to join in as an organizer. So.
But thank you very much. And that's I actually thought to start in Europe, we are always very good in saying everything that doesn't work in Europe. And I wanted to start actually with a couple of reflections of what actually did work in Europe. And I think what we see is a few elements that I think is important is that actually Europe is demonstrating that it's capable of fulfilling its role in the global context. And then talking about a couple of points that I think we should remember on the positive side. In terms of decarbonization, Europe has a legal binding commitment on decarbonization for 2050, is close to reach the decarbonization target of 2030, and is working on the path, on defining the clear path for 2040. So it's a legal commitment, is put in place. We have, and we are working, experimenting with the carbon price in the ETS. Yes, there are a lot of things we could enlarge the sector, etc., but it's working. And we have a strategy on the decarbonization that shows at the end, in a global context, we take a responsibility for the environment very clearly. The other point on Ukraine, I think as well, it has been very, very difficult, but Europe is putting together resources, has approved. It's on the delivery phase for the resources for Ukraine. In 2024, we are planning to deliver 15.9 billion support to Ukraine. So here again, with all the complexity, Europe was managing to put back and align on its global role. If we look at the economic point of view, I think everybody was already saying we had a much stronger trade shock with the energy crisis. We are on the process, and the central bankers will say it better than me, but on the process of stabilizing inflation, and that is coming with more or less a soft landing, somehow avoiding the recession. But what is interesting is that the plan that has been put in place during to manage the shock has also quite important features. Has put the concept of investment and transformation at the center of the European policy response. If you look at some of the countries of Southern Europe, and I talk about my country, nobody ever saw the investment in machinery and equipment that we have seen in the last year. May have been done better, maybe in less expensive way, but this kind of investment hopefully will have an effect in the future. And it's the same that we see in many Southern European countries, Greece, Spain. Spain is not investment, but is still going very strongly. We see most of the Southern European countries putting together effort. And then two other things that I think in Europe we are looking with attention. There are two reports that are coming up that will have hopefully a very strong political pressure. One is the Letta report. Letta, former Italian Prime Minister, actually the 17th, so tomorrow, will release his report on the single market. It's a deep rethinking of the European single market and looking at all areas for future transformation to really re-exploit the single market. And then in June, there is a second report. June, actually, I think it will be second after June, but a second report coming up from Draghi that is, again, looking at the competitiveness in Europe and how to support competitiveness. And that means that at the end, with all the complexity of the moment and with all what we know about the negatives, there is at least an attempt of really putting the dialogue on how to complete the single market and on competitiveness of the European economy. And I think this should not be forgotten as a positive point of view. Then, with all the positive, I think we still have, and that's something that we point out since years, after the financial crisis, we saw this gap in terms of productive investment, what we call that was developing between the EU and the US. So Europe has every year since the sovereign debt crisis actually is accumulating a 2% gap year after years. This lower capital accumulation is also reflecting on the data on productivity, etc. We have a bit of thinking of if you look at the data, in fact, what you see is that per capita GDP in the EU and the US, starting from the 90s, there was a big gap. And then if you think at constant prices or purchasing power parities, what you see is, in fact, that the gap didn't expand, didn't close either. So they are going hand in hand. So for sure, there is something to do, but Europe is not performing worse. It's just about converging. And that's something I think that is important to look. In terms of the policy, I think a lot has been said. I am particularly, I think, concerned on a few elements, and also maybe for the institution where I work on, a lot on the innovation side, on the scale-up side, the financing. But here we also see one element that is important, particularly on, we have a new study coming out on green innovation. So firms that are innovating in green technologies. What comes out is that they basically face two major problems. On the one side, the usual issue on scale-up finance that European firm, innovative firm have. The second part is they consider the very important assets, the coherent regulation within the single market. So again, it brings back to the issue of having the full integrated single market, also in the energy, also for the net zero transition side and for green innovation as a coherent system. Another point I wanted to mention I was briefly talking about the decarbonization, and we have been looking at what is happening for manufacturing firms that are covered in the ETS system. So those that are actually integrating and with the carbon pricing. What we saw is actually that over time, the progressive tightening of the ETS and the carbon pricing is actually leading a firm to decarbonize, at the same time investing in innovation without a massive effect on production. So there is some positive on the use of carbon pricing and the ETS on the manufacturing sector. We also see one element that is tricky. We see that there is a divide emerging among firms. So there are firms that are leaders in the decarbonization process, and there are firms that are laggards. The leading firms are really the ones that are innovating, investing more, innovating more, and they are keeping in net term production capacity. Then we have the laggards, and the laggards are really not investing. They have investment gaps, and they are thinking about retrenching. So they are in net term reducing production capacity. We think that this divide among firms will be important to be managed because uncertainty on regulation kills both the firms that are leaders and the laggards in the decarbonization process. So whatever uncertainty we have in the system in terms of the path of decarbonization, the timing or energy cost, etc., may kill the incentive. And then particularly scaring for the laggards, because then they will really not do anything and the only option will be closing. It's a long story, but I think on that side, maybe Europe having both sides of the policy, that is on the one side, the carbon price, that force the transition also of the carbon intensive industries. And then on the other side, maybe we can do better, but we have as well the support side in terms of incentive for innovation. We are covering both sides. While in the US, only relying on subsidies, first of all, is costly, but then it's not sure that the whole decarbonization will take place, particularly in the carbon-intensive industry. So that's another point I wanted to mention. The last point maybe is on resilience of value chain. I agree very much with Boris. It's coming. Also, for the moment, European firms are mostly in the value chain. They are mostly trying to invest in resilience. So they are trying to diversify a lot of investment in digital tracking. So they try to have a more resilient value chain. But what is coming, I think, in Europe has always been a bit more reluctant on the concept of industrial policies. But now the point starts being, let's do good industrial policies, hopefully European. I think the fact of not doing industrial policy is off the agenda by now. So there will be something coming, hopefully, and I think that's what everybody is trying to do, more European rather than national, to really protect the competition in the European market as well. So that's the point. And with that, I close. Thank you.
Thank you very much. This was a truly valiant defense of Europe. So thank you for that. And I should mention Deborah is the architect of probably the best, or certainly one of the best firm level surveys that the European Investment Bank is doing. And so part of what she was referring to was from the firm level survey, which is done in all the EU countries and the United States. So there is a comparison with the US that's in the survey as well. And you mentioned one point which I actually wanted to bring up, and it's totally natural, and that's the importance of support for Ukraine, which is important from Europe and the US as well. So I think there is commonality that started and should continue. And in that context, I'd like to circle back to Don Blinken, who, as the U.S. ambassador to Hungary from 1994 to 1998, was instrumental in the Budapest memorandum, which some of you may recall. The Russia, U.S. and Britain signed that nobody would violate Ukrainian borders, and the Ukrainians, as a result, gave up nuclear weapons, probably the last country to give up nuclear weapons as a result of what happened afterwards. So Don was, extremely important in that. So in addition to his career in investment banking, education, patronage of arts, etc., he was, really instrumental in a global issue of this dimension. And since he and Vera met them, it was also important in the personal level. So that's very important. Now, having one chief economist, it deserves to have another economist, chief economist follow up. And Rolf Straub is the chief economist of the European Stability Mechanism. Rolf, it's great to have you back again.
Thank you. Thank you for inviting me in. Great to be here to contribute to the discussion. Obviously, a lot on the challenges for Europe has been said, and also on the policy perspective, what to do with it. I would like to pick up a bit on that point that you also raised, and that Isabel referred to, this question about competitiveness and resilience, because I do see the risk that this increasingly is kind of pitched against each other. And my fear is indeed, in case US policy changes even more and becomes more, if you wish, isolationist, the quest for going for competitiveness and basically giving in on resilience will become even stronger, and that is a risk. Why I think it matters is because if we think about the big challenges for Europe, there is this issue about also having resilience in this more fragmented geoeconomic, more shock-prone world. And also if you think about climate change, the impact of climate change. So the two things need to go together. So in terms of policy packages and what's next, for Europe, the question is, what comes in the next institutional cycle? We have the European elections this summer in less than 60 days. So this will be crucial in setting the stage. And here, I think there are a few key pillars. One is that Europe has decided on this new fiscal framework, or the new framework for macroeconomic coordination. I think overall, with all the questions that come up, but it was a good move in making policies more medium-term oriented. For example, for fiscal, there is a stronger focus on debt in order also to set incentives for investment. And this will be crucial, again, in order to achieve that transition that we have. By the way, one of the points also that can be mentioned that shows the resilience of Europe is that with this cycle, or with the crisis that we have seen for the first time, public investment is not going down as typically does in this pro-cyclical way in Europe. So, and that needs to be continued. For this to work, the next point is that governments need to put in place credible and high-quality structural fiscal plans that should govern the next 4 to 7 years. That will not be an easy task. It has to be done over summer, and that should set the path then forward-looking. And importantly here is that there must be some ownership with the overall framework and the way forward on that. For me, what is crucial and is for this to work, we must have more growth. We must have more space. Otherwise, it will politically not be sustainable. And that is why I think the other elements that were mentioned about the single market and digitalization are crucial elements of an overall package that can work, because if we get this done, we can have more growth and we can generate the fiscal space, which otherwise will be left and where we will be just kind of falling behind the own commitments. And here, I mean, the single market per se is a win-win situation in very many respects. The IMF has computed that it would bring, in level terms, could bring a complete single market, could bring 7 percentage points higher GDP. So this is very significant. The initiatives are there. They are big. We have later this week a European Council. We will discuss where this will be discussed again against the Letta report next to defense issues. So there's quite some momentum in there to make some progress, because there is more political pressure felt to go about it. But we must also admit there is still some resistance. And I hope that resistance can be overcome. And resistance also exists still when it comes to financial sector. And here's probably also where, like in capital markets, creating a true common market where basically the big gains can be made and should be made. So that is the second part of the package. The third part of the package is what Isabel also referred to is the financial infrastructure, Europe forward-looking. And yes, there is a call for a common fiscal capacity, and I fully subscribe to that. But if you look at what we have in Europe now, so we have Next Generation EU running till 26. We have the ESM as a permanent crisis resolution mechanism. So these things are there. If we look at the overall resources committed in Europe so far and what has actually been used, it's about somewhat more than 1/3. So there are still resources there. And our goal is to make sure that those resources can be efficiently used, will be efficiently used, forward-looking. That also relates to the role of the ESM as a crisis resolution mechanism, where we think we should be more also geared towards the shocks of the future, which is not the traditional balance of payment shocks, but essentially climate change related, or maybe foreign policy change related shocks that may happen. But it also raises the question, what happens with investment, European support for investment after Next Generation EU has ended? And there will be tough choices to be taken. And thus, basically, one way forward could be to take a deeper look into the European budget and what can be done in that context. And there are now first initiatives towards that direction, or whether some of the money that may not be used under Next Generation EU may be used later on in a different context, or whether fresh money is needed. And I mean, at least when it comes to Ukraine, indeed, Europeans have shown that they're also willing to put fresh money on the table. How this will look for other areas is harder to predict, and obviously there are also very different voices in the room. In any case, before Next Generation EU is fully implemented, that is a very complex discussion, and that is why that is there as the priority for now. That is roughly how I would look at the current landscape when we go into what sets the stage for this next European institutional cycle.
Thank you very much, Rob. Yeah, those are important points, and some are huge challenge, some are obviously within reach that should be implemented. So our next speaker is Brunello Rosa, who is CEO and Head of Research at Rosa and Rubini Associates. Great to have you here, and looking forward to your points. Yeah, please get a microphone.
Thank you. Okay, so clearly a few points have been made, and I'd like to make comments about them and possibly adding some extra view. So how can the EU increase its competitiveness? So a few approaches, I would say. A micro approach, if you want, is the one that Deborah mentioned with the two reports by Draghi on competitiveness, and later on the single market. And this is clearly important. Draghi said he wants to have radical change. We don't know exactly in what terms, but it's going to be radical. It's not going to be incremental. And later mentioned a number of sectors in which we do need to complete the single market, in particular telecommunication, defense, and on, a capital markets union, which is something that will be extremely important, but is never coming to some extent. Even one component of it, the banking union, is not completed. So micro approach, first step. Then you have the institutional setting that to some extent Alan was referring to, in the sense that people sometimes speaks about the United States of Europe as, where the tendency of it. But we are not there yet at all. At the moment, we are a bit in the middle between the initial state and what might be the end state, but we don't, it's like we don't fully exploit the efficiency gains and economies of scale that would derive from a fully unified European Union. But potentially the United States of Europe is not what we should aim at. In fact, I think a Europe made on concentric circles will be so much better. And this is different from the two-speed Europe or multi-speed Europe people speak about, because in a multi-speed Europe, the destination is the same. It's just countries arrive at different times. But potentially, countries may not want to achieve the same end goal, for example, joining the euro. In a concentric circle setting, countries will choose where they want to arrive. Some will want further integration within the euro, others will want to be in the EU, others will be part of an outer circle of which we can call European common space, and the UK will be part of it, Turkey will be part of it, Ukraine should be part of it immediately, unless at some point we want to join the EU. Countries that are problematic, such as Hungary, will need to choose whether they want to be an element of difficulty in the EU or will just want to be part of the European common space. And that would there is a study group on this. I think it's called the Group of 13 or something like that. But it will take lots of political capital to be spent on that. Now, on a shorter term, whatever the institutional setting, a Hamilton moment is very much needed. And we are not there yet, in the sense that even the bonds that are issued to finance the next generation EU don't enjoy the joint and several guarantee that would define what is called Eurobond. We are not there yet, simply because I'm going to be rough and not politically correct. The Germans don't want to pay for other countries in case they don't respect their obligations. So if we want to have a common defense spending, you need a Eurobond properly defined with joint and several guarantee. It cannot be this halfway through that we had so far. An example of that, Patricia mentioned that, innovation in finance and digital. I'm looking very closely at CBDCs, central bank digital currencies. I'm actually writing a book on the geopolitics of CBDCs, which is absolutely crucial. And the key thing is that there's only one CBDC out there, really, apart from the Sun dollar, and that's the ECNY. What's the response by the European institution is the digital euro that, thank God, is going as fast as possible. But where is the US in this game? Is nowhere near to be seen. Why? Because they feel that anything that you do of innovation can challenge the dollar supremacy. And instead, it would be very important that the US takes the lead, not the back, being on the back foot on that very crucial innovation, which will have very significant geopolitical implications. And on that, I want to finish on another point that was touched on. The IRA has been mentioned several times. Now, when the IRA was issued, lots of European companies, some applied and so on, and there were many complaints that the US was trying somehow to lure European companies to the US, and there was somehow unfair competition and something like that. I don't think that's the right approach to think about it, because in a new geopolitical order in which you do have the West versus China, Russia, and that bloc, you need to think about the US and the EU as joined, okay? If they are joined, in reality, the IRA is a massive favor that the US has done to the EU. The US taxpayer is financing another way for the EU to get energy away from Russia. So, and we know, and particularly countries such as Germany, Italy, and so on, how strong was the relationship between with Russia regarding the import of gas and so on. So the US, in a broader geopolitical sense, said, look, we can offer an alternative. Yes, I know between the two of us, you can think, you're taking some of our companies here, but in reality, if you think as a combined bloc, is actually, I think, a very generous act from the US, financed by the US taxpayer. The same way NATO is an umbrella that is offered effectively by the US to the Europeans. And clearly there are complaints that the Europeans should contribute their share. So I think it's very important to look at these elements when we want to talk about increasing EU competitiveness. Thank you.
Thank you very much, Brunello. I would next like to invite Sherin O'Halloran, who is the George Blumenthal Professor and Professor of International Public Affairs at Columbia. When I actually was interviewing to come here, I was very impressed when I met with her by the breadth that she has, spanning economics, sociology, law, and the databases that she's been assembling for her work are really tremendous. So it's terrific to have her with us. So Sharon, please, could you give us your remarks?
So thank you very much. Thank you very much, Jan, for inviting me to join the panel. I am actually in Dublin this year. I'm visiting Trinity College Dublin, and I've been here for the year and next. So I actually have a perspective that is both reflects the U.S. and the European Union at this point, at least from the Irish perspective. So what I want to do is put a little data around some of the conversations that we're having. And when we think about competitiveness, usually trade is one of the key aspects of it. And when we think about competitive trade, we think about it to what areas do we have a comparative advantage and what areas are complementary, and how do we have gains of trade, and how do we have build on the economies of scale, of which the European Union as a whole actually does a great job in doing. But what you see here is that in some of these trends, that since Brexit, the UK leaving the EU, the EU trade with the US has actually increased. And it's done so especially in areas such as chemicals, machinery, vehicles, and food and drink. And so this is an area in which there's a lot of complementarities at which both the parties have been able to gain. And also then what you see is that when you think about what's the impact of U.S. trade relations with the EU, and particularly when we talk about the transatlantic trade and investment partnership that has floundered, then we have to look at to what extent does each of the partners rely on the other. In this case, you see that U.S. represents about 20% of Europe's exports and about almost 14% of their imports. And on the flip side, then you could see that the EU represents about 17% of U.S. trade in goods, 25% of its trade in goods and services, and about 44% of its FDI. So when we're talking about the flow of FDI into Europe or into the United States, you could see that there's actually quite a lot of input into that. And actually, if you look at the reverse, it's positive into Europe from the United States. And I think this has something to talk about, because the issues around some of the policies that have been raised is that, in fact, it was a draw of EU policy into the US. So this may be one reason why you're seeing the different types of policies taking place. Moreover, you see that the U.S. runs a negative trade balance with European goods and a slight positive in services. So this is sort of the landscape that we have to think about. Now, add into this some new policies in infrastructure of green and digital and semiconductors. And I'll talk mostly about the Semiconductor Chips Act and the subsidies to the green technologies. And you can see the two pieces of legislation have come out of these very large omnibus bills that were passed that really give tax credits and subsidies to the producers of cars and vehicles and other green technologies, such as to expand the American base of electrical vehicles productions. You also see the CHIPS Act, which also took an incentive-based approach, which is to focus on semiconductor manufacturers in the U.S. And this was partly in response to China, but it was also partly in response to having innovations and moving subsidies into those areas to have the improvement of technology and issues around resilience in the supply chain as well. On the flip side, you have very much a mirror image in the types of legislations that come forward, but very much a different approach. So you have the European Chips Act, which again focuses on research and development in the semiconductor issues, and then focusing again on issues around the supply chain disruptions that took place. And in this, and as well as the European Green Deal, which requires green technologies and standards to be implemented in a set of stage steps. The difference in these two approaches is pretty important because, one, in the EU regulations, they're really focusing on an increase in demand. And why is this? Because these are command and control regulations that puts the onus mostly on the individuals, say homeowners, to actually install either green technology, come up to grade, and so forth. So it's going to be a demand push. And the other, on the US side, which looks at subsidies, it's actually going to be a supply push, an increase in supply. And in this case, then, what you're seeing is that each of these approaches are sort of solving different types of problems. So in the case when you want to regulate US and use green and technologies and semiconductor technologies to increase the demand part, you're going to be affecting the demand by the consumer. When you're looking at it with subsidizing, what you're going to be looking at is increasing the supply that is produced by producers or firms. This obviously is going to have distributional consequences or effects, right? So the different approaches really is focusing on different parts of the demand and supply aspect, right? But both are going to could have an effect, an adverse effect that's shifting the supply, the surplus, right, from the consumers to producers. But let's see how that might happen. In the U.S., that approach that aids producers by subsidizing R&D and production, right? This could have the supply effect, as I was stated. And if it increases supply, hopefully it'll improve consumer choice, right? And as long as that market is competitive, then consumer prices for green technologies could decrease, all things being equal. But in Europe, you have a case where it's really a demand effect. And in this case, then, if it's a demand effect, you would anticipate that prices might increase for existing products or and this would increase the amount of rents that existing producers may have. If this increases market entry, though, because prices are going up, there's more demand, then prices may actually come back into equilibrium and choice may increase. Otherwise, all you'll have is that existing firms will be able to extract additional rents. So one of the implications then is that you could very well have this race to the bottom and just have increasingly prohibitions on trade and competition, right? So in the short term, you have these individual policies that may attract domestic and foreign investment, but in the long term, you could get manufacturing processes that are both more expensive and inefficient and are just going to be passed on consumers, especially when you have regulations that are mandating that that consumers use these technologies, whether in their home, in their cars, or what have you. So you also get the case when you have these regulations may yield protectionist policy, that's in the semiconductor cases, that could turn out to be counterproductive to the outcomes because they're protecting existing producers. And it's not clear that they're going to improve the resiliency of in this case, the chip supply chain, or they're going to create a more sustainable environment. So thank you.
Thank you very much. These are indeed very intriguing propositions for the discussion that will follow. But before we get to the discussion, we have two more speakers. The first one is Jose Antonio Campo, who is known as the true international global gadfly because he effortlessly switches from being professor here to being Minister of Finance in Colombia to being a senior person at the UN, World Bank, IMF. We're looking forward to your comments.
Well, thanks, Jad, for this generous introduction. Let me say that I'm learning here. I am not in the topics of the U.S. or the European Union, so so that's why I asked Jad to put me last.
You're next to last.
Next to last. Anyway, but let me at least from the perspective of the world I see, which is very much international organization plus developing countries. Since I'm from a developing country, some comments.
The first one that I see is actually that the main challenges are the relations of both the U.S. And the European Union with China. I think that's the main tension that is going on. Actually more or less similar policy, let's say, to face the two. But at the same time, we have this, which is, I see for science and technology being more the European policy, but that's WTO consistent, let's say. The U.S. policies are not clearly U.S. WTO consistent. You can think of the tariffs on aluminum and steel decreed by Mr. Trump, the magnitude of the subsidies of the Inflation Reduction Act, and of course the subsidies on semiconductors. I mean, all of those, really raised one important issue, which is who is going to regulate industrial policies so that they are consistent with trade partners, world trade policies. I see that the WTO meeting that took place like a month ago, there was no discussion of this issue, which I think is probably the main issue in this area. Anyway, so I somehow feel that there has to be, in a sense, a common negotiation between the U.S. and Europe about how to manage this issue and present policies to WTO, so that the WTO makes it consistent. Anyway, so the relationship between industrial policy and trade, given the ambitious industrial policy issues that are going on. By the way, in the first issue of China, some developing countries are getting concerned also now. Brazil just adopted policies against Chinese dumping. It's a very important issue given that China is the main trading partner of Brazil. But many other countries are actually looking at Chinese. So the issue of the industrial policy, the common industrial policy of Europe, the US and Europe, is also how to regulate Chinese, industrial policy, let's say, because, so that's one kind of comments that I made. Now, I actually am concerned somehow, looking at the story of Europe, from very outside. It's quite clear that Europe for a long time has been the leader in climate policies. That's very clear. I experienced the UN that with very strongly so. But at the same time, let's say from the point of view of Europe, I guess eventually it could be accompanied by kind of tariffs on the damages of the imported generated by the imported goods. Okay, that's one issue that maybe also at one point very clear. But so long as that doesn't happen, this is costly for Europe, versus the rest of the world. It's be it in taxes, carbon taxes, or regulations. For example, the issue of agricultural regulation that have been generating lots of protests in Europe itself. That's it. So I think that's an issue that I don't know how Europeans would be able to manage, because I'm not sure they can be managed through tariffs on imports. And let me say from at least from the point of view of the let's say of the developing world, they have always told the Europeans in that regard, it's the consumers who have to pay the tax, not the producers, because the guilty party, let's say, are the consumers, not the producers. Let's say. Anyway, that's an important question of who the hell is going to pay for example, carbon taxes of some sort. Anyway, and finally, let me. In the digital world, the impression, and I guess it hasn't been clarified to me by this meeting, is that Europe is really lagging behind in the digital technology world, and what the US is clearly one of the leaders. But on top of that, we also have the Chinese leadership in the digital technologies. And that raises, of course, questions for Europe on the one hand, but also due to the protectionism that is taking place, in a sense, not allowing, countries to use the Chinese technology, let's say. Let me say, from the developing country perspective, this is a bit of a mess because it's like the world is in a dual technology path. So if you are a developing country, what the hell do you choose? Are you going to with China or are you going to with the Western countries? It's a really big mess. I mean, so it's a concentrate. But no. The problem is, let me say that the importance of Chinese trade. Let's say South America, China is the main partner of South America in trade. Is becoming a very important investor and, of course, supplier of technology. And that's the Africans, which actually, in one sense, prefer to deal with China because they're also big suppliers of financing and investment, direct investment. And the Southeast Asia, which for regional location, of course, trades a lot with. So the whole South, let's say, maybe with a few exceptions, don't want to be in this, let's say, this Cold War, technological Cold War, in which we seem to be going through. Actually, just a final curiosity, when the deputy of the IMF went to the International Economic Association meeting in December, she had this issue of the Cold War in trade. Several of us, including me, told her, please don't get us involved in the Cold War in trade. Maybe we'll get involved in the Cold War in politics, but not in trade. How could, because China is a good trading partner for many parts of the developing world. And it's in many cases, the most important trading partner today. So this issue of the geopolitics and how it affected trade is, it's a big issue for both the U.S. and European Union. Big issue.
Yeah. No, thank you. Those are terrific comments, and that brings us to Bruce Kogut, who is Sanford C. Bernstein and Company Professor of Leadership and Ethics and Professor of Sociology at Columbia Business School. Bruce is, in some sense, the most consummate and terrific social scientist that I've met, and we've worked together for decades, actually, various places. He moves across continents, so he's been at Wharton, at INSEAD, Columbia Business School, etc., and combines the acumen and insight and logic of both an academic and a policy-oriented person who also understands things at the level of the firm. So, Bruce?
Thanks, George. Very, very kind. With the underlying explanation, I married a Swede, and I got a Swedish passport, and I have to go back sometimes to see my mother-in-law. So I have some European exposure, I guess, as well. And we've known each other for a while, going back to the days of the World Bank investigations in the 90s, those policy issues, which had a great effect upon me. I was probably more engaged in economics at that time than now. It's probably because I was unhappy with some of the policies which came out of that period of time. I'm going to keep my comments short because you want to have a discussion. I know. I just came from Las Vegas. I should tell you that.
How much did you wait?
I have a brother-in-law who takes care of that for me. So the Las Vegas is always a mind-blowing world, much in that respect. You have to spend at least many days there before you begin to see it. because the first few days are totally, depressing. But there's a logic there. And what I learned was that food there, I never was too impressed by, but I learned that if you focus on the dessert, it's really great. So I spent a lot of time just eating desserts, having no space left over for the dinner. So that's still like macroeconomics, which does it the other way around. You spend so much time on discipline or worrying about the diet. They never get to the dessert. So that's a bit of the back and forth of these things. In the U.S. as well, the discussions about regulation in the digital markets, et cetera. There are some needs. There are several needs to have regulations in these markets, and there's some major debates there. But in the meantime, the desserts are great, Patricia. They're really great. They're really wonderful. And SVB did fail, but the consequences weren't that large. And you have FTX, which failed, which is a much greater scandal than SVB. It pretty much went through, a quick response. It's a fairly demoralizing story about a young man, but otherwise, it was cleaned up fairly well. It's not clear what Mr. Gensler, who I know has been here before at SIPA and also at Latif for a short while, becoming the Securities Exchange Commission. Seems to be eager sometimes to clean things up around this. But then you kind of wonder in terms of innovation in financial markets, which was stressed here. I agree with that stress. Whether or not a larger gain to it if we look at the dessert rather than the regulations, that's the first part of the meal. And there the U.S. has done well. And this extends to all kinds of financial instruments, which we don't, talk about, but you guys all know about very well. It has to do with the way we structure debt instruments, all of these, complex instruments which have equity as a first tranche and debt as a later tranche. And that's been used in lots of places, even areas which you wouldn't think of being used, like should philanthropies be taking on risk, which sounds like a very American view of things, once again. Thinking about the dessert recipe, rather considered match and rules which we have. But then you kind of come up and say, well, we're just using the income statement. That's how we pay ourselves in universities. You give us $100 million. We take out 5% of that for the income per year. But we don't think about the balance sheet itself as interesting collateral for the actual investment, like the Gates Institute does. So someday you can free up a tremendous amount more money for investment by thinking about this in terms of investment on the opportunities on the balance sheet. Now, I'm not going to go into the details of this because I know you know this, other than just to wonder with I think appreciation that financial markets really is pervasive in the economy. It takes place in so many different areas which you would not think it exists, and it has played and will continue to play a role. The Ford Foundation right up the street out here certainly did that in the case of Detroit a few years ago. So that's just an example. We look at green bonds on the other hand. There was a study done by what's it called in German, the Bank for the Leader for the reconstruction of Germany. What's that? KfW. Yeah, KfW, right. So so the credit for the reconstruction. They did this with Denmark and other countries about the value of green bonds, which is a big discussion in the U.S. because everyone's saying, is there any value to these sort of initiatives which have green attached to it? What they found was that they took these. In one case, they created two securities, identical, except one had a green bond, a coupon to it, one did not have a coupon to it, and looked at their trading. And it's true that people were willing to strip off the coupon part, saying, which is crazy, just saying this is a green bond, covenant. And there's a trading value for it. There's some people who will always invest in those kinds of things for consumption. They just make them making more persuasive. They compared the green bonds across several countries. And this central bank, locally, the regional, the national banks from that and they did not trade too much at a discount. The green the green bonds. People wanted to buy these things, but there wasn't much a difference either. So if you compare the things which governments sometimes do, they were all good intentions. On the other hand, what's happening at the micro level in financing, grain financing, you have to be kind of, sometimes tempted to say that the dessert is being more enjoyed by the private sector than it's by the public sector. That is also true for energy. It is true that we use subsidies in the U.S. more than elsewhere. We generally use subsidies. It's subsidies on solar and house financing. But we do this all kinds of places. But then we allow people like me who put solar on their house to strip off the sell them in markets. So I sell them as called SREX. I sell them; they're bought up by industry. But after that, my friends tell me who are in the field of green finance that I no longer have any right to brag. Because I sold my greenness, my coupons, right, for profit in the market. And I should really enjoy it. But really should not go to a party and say how great I am because I just ate my dessert. It goes to someone else on this. But a lot of people just want to say they had both. They got the money and the dessert itself, and that how it actually works itself. There's one last thing I want to say here, and then I'll let you all out of that discussion. And just taking a little bit further, this idea of private versus public. And I'm not crazy. I'm not like, I'm not out, the northern parts of North Dakota and elsewhere. But I am maybe closer to Wyoming. I'll tell you why. There's something now which is happening largely in Miller, called these decentralized autonomous organizations. Maybe you've heard about these things now. So it's super interesting stuff. Not very well regulated. Some people estimate something like 20,000 now, 20 or more exist. The first one, which was created, of course, stole people's money in the blockchain contracts, and immediately had a problem. Can you rewrite the code, and can you get the money back? And is anyone guilty if they actually did it? It was illegal theft. It was actually illegal in law itself. But now it's up and running, and it's doing really very interesting things in investment clubs, in issues of financing for particular goals such as climate change and elsewhere. It's very much attached to certain platforms you may know more than others, like Ethereum, which is primarily based in Berlin, if you look at it. Swiss are very much behind it. They do a lot of work with legal work in the areas of DAO. And it's a very interesting thing to look at. I don't want to exaggerate the economic significance. I do want to exaggerate for you what the governance implications are, and that's the ability these days to really write very different governance contracts today, which are private in nature, maybe have some degree of legal oversight as well, which I think is playing increasingly more of a role for a democratic inclusiveness in financing or areas to think about climate change, et cetera. And that's something I think schools like SIPA or the business school itself should be looking at. I will tell you that the law firm sees plenty of future fees in this business because every innovation is a bust. So you can't lose. You're a player on both ends. And into my comments.
All right. Well, thank you very much. We'll have time now for discussion. I'll just make a few points maybe that came up or didn't come up. So let me start with the one which Deborah and I have been talking about. If you look at the statistics, GDP growth over a long period of time, even a short period of time, the US is outperforming Europe very significantly, except for Central Eastern Europe, which is outperforming even the US. But that's part of Europe. If you look at GDP per capita or GDP per person employed or GDP per hour, actually, the advantage is gone. Basically, over 25, 30 years, shorter periods of time, the US is not growing faster on those indicators. So depending which indicator you take,
it's there, and the US had huge increase in population, and that obviously increases the size of the economy. So one should take that into account. Second is we had the discussion that with improvement in the single market and so on, there should be significant gains in GDP for Europe. Deborah and I, together with colleagues Yuri Gornichenko and Christoph Weiss, have been doing some research using the turnover data that her survey is collecting. And there, I think if we are finding that if the Europe increased its efficiency of resource allocation across borders, across sectors and so on, just to the point of the US, not perfectly, because the US is not perfect, the GDP would be about 40% higher. So that's our estimate based on turnover data over time. So just, keeping that in mind. Some of the points that I think,
Could you repeat that?
what if a resource allocation, so if workers moved across borders and sectors, so they were beginning to equalize marginal products across, and similarly capital, okay, but not perfectly, just the US. US is not perfect. So we went with the experiment just making them become that efficient or inefficient. You would actually increase Europe's GDP by 30-40%. Yeah. Now, I think that among the points that have been made here, I think that question that Rich posed, how much of Biden's priorities would remain or will remain if Biden stays in power, there's obviously a question, how much will remain if he doesn't stay in power, right? So that's a big question that everybody's in a way asking. I think we've touched on China, and it plays a big part, but it certainly, in some sense, deserves even more of a thought and discussion. And then what has been raised is the fact that Europe missed the train on digitalization in the 1990s and has huge effects to this day. And AI is sort of the next wave, and that has been raised, and I think that's really important. I think Boris's point that prices can be of energy 3 times as high in Europe compared to the US, I think is on target. I hear that from firms too, especially those that move. The question is, why is it remaining so high? You could see that in some sense shock, etc. But a lot of it is transportable, liquefied natural gas and so on and so forth. So transportation cost is there, but why 3 times? That's a differential that we normally don't observe. We are used to differentials of 20%, 30%, 40% in various areas, labor markets, other markets, and so on. But multiples is hard to maintain over time. Other point, I think the Leighton report and the Draghi reports have lots of things in them that I think are really valuable and presumably could move Europe much closer to the US on number of indicators. And I think that the question of China and protectionism or reaction to it, as Jose Antonio mentioned, even Brazil now, reacting. So it's the US, it's Europe, Brazil, and others. So that, I think, is a big question. And to what extent will the World Trade Organization be put back into a functioning mode or not? Because that has been a cornerstone of what has been happening before. So anyway, just a few points to add to it. We have sometimes for discussion, I just see if people come in with quick comments, questions, etc. Boris,
just to answer your question on the energy prices, it's gas mostly. And the reason is that you can transport it as an LNG, but then you have to liquefy it. You have to deliquefy it, and you have to move the tanker, and that costs. That makes a huge difference. I can tell you that now Croatia makes money after the Russian aggression because we have an LNG terminal, which was that was interesting story. So there was a intention on our side to build the LNG terminal, which is the closest to the settlement, East Europe, in Rijeka. Right? And we were asking the Hungarians, Slovaks, Austrians, everybody who wants to participate in the equity of the LNG terminal. And for years, nobody wanted, because the gas that was coming from Russia was so much cheaper. Yeah. They said, why would we put money? And they said, we need some, because otherwise it's loss-making thing. So let's just keep it like a break-even as an alternative if, so nobody wanted. And then, the one country that was resisting so much was the US. And in the end, we built it just a year before the war started. and they became extremely profitable.
Yeah.
But the gas that flows through that is for us it's a money because it's a cash cow. It's a pipeline and the facility, but it's much more expensive. One thing as a central banker, maybe one point that I thought about on all the kind of industrial policies that are getting in place in the US, China, Europe. And it's becoming so mainly because of the geopolitics. If you think back, it actually started with the Obama administration.
Yeah.
They refused to sign the deal with Europe. Then Trump, China, and now everybody with everything. And now there are a number of things as we speak in pipeline. So it's going to get worse from here onwards. The geopolitics does not seem to get better. So for a central banker, if you think, where did you have inflation pressures? Basically, they were always connected with their geopolitics. Right? A very smooth period of actually deflation even in the US, end of 19th century, with a high productivity growth, actually even negative price growth. But that's the highest growth in the US. Then I had right over the First World War, geopolitical tensions, prices went up between the two wars, between 1918 and 1945. Had hyperinflation, Great Depression. Then again, it smoothed out. In the 70s, it was geopolitics again. Middle East, Iran, had an oil shock, another flare-up of the inflation, which took time, then came down. And now we had another bout of inflation burst after that because of geopolitics again. Because partly because of pandemics recovered, but then the Russian. So if the geopolitics is bad for inflation, we're not in a good trajectory. Maybe the R-star will be higher. Interest rates will be higher, which does not mean that the investments will be low. Because if you go back when the interest rates were higher, you had a lot of investments actually, more than when they were negative. But the R-star might be because of geopolitics also. Like that.
Yeah, Trish.
So I had two really quick reactions to something Antonio said and something Bruce said. Technology policy is actually national security policy now. It's not really economic policy. They said technology policy is national security policy now. That's my read. It's not economic policy anymore. So the divide you're talking about, unfortunately, unless the geopolitics, as Boris pointed out, gets better here, which I'm dubious in the short run that's going to happen. I'm a little concerned the whole world's going to have to choose. And a lot of stuff is going to end up on two sets of rails. I mentioned the finance part of this, but the reason I'm so worried about thinking that the official sector, the central banks, the regulators, whatever, most probably in the representative democracies have got to get together and figure out what they want to do about that little narrow set of international cooperation, is because there's a parallel system going to be set up over here, which is crazy inefficient, of course, but it's sad, but I think it's probably true. Anyway, that wasn't what we wanted to hear. I know. It's not what anybody in the rest of the world wants to hear. It's not what anybody anywhere wants to hear. The reaction that I had to Bruce's is, I completely agree with you that you gotta get to the dessert, and you can use finance, you can use innovations. Finance is always so fragile that you always worry about that one, because when it goes out of control, it's bad. The trick is to figure out when you've had too many desserts. And so, because when you have too many desserts, then the public sector cost is just enormous. And that's the trade-off that you kind of never get right. You need medium-sized blow-ups, but not big ones.
I agree with that.
Right. Anybody else? Rich, Isabel, anybody around the table?
Well, I'll parse in a little bit. It may have changed because I've not been with the Fed since 2021. But from their public comments, I don't think it has changed. Speaking narrowly now about central bank digital currency, obviously this is a much broader topic. The Fed's public position, and I take them at their word, the Fed's public position is that in the case of the U.S., that would be consequential enough that the Fed would only pursue a CBDC if there were specific enabling legislation. Otherwise, the Fed's doing some R&D, and it wants to understand, as Trish alluded to, the various and sundry parallel payment systems that are evolving. But unlike what I pick up both when I was at the Fed and since from European officials I respect, this is not a priority for the Powell Fed. In particular, I think at one point Jay Powell said, it would be important for the Fed not to be first, but to get it right. But since then, the position has been very clearly that it's not something the Fed would even consider pursuing unless and until there is enabling legislation. And the basic rationale is the Fed is a creation of Congress, and the Fed's mandate is in statute, and this is consequential enough that the Fed as an institution is really not going to go down that road. Now, future Fed could have a different view, but that is the thinking. And so, I mean, to Trisha's point, it would, for example, if that's pursued, say in Europe, it would be difficult for the U.S. to coordinate since the U.S. is not pursuing that destination. So,
Great. Yeah, Ross.
Well, the good news for Isabel and for the Europeans is there's, I think, a big first mover advantage if you move into that space. And basically the ECB and the Europeans may set the standards. But I wanted to come in on another point, and which relates also what you said, Richard, and what Jose Manuel, what Jose Antonio said, which is this joint interest of the US and Europe in this geopolitical situation being basically the relatively most reliable counterparts. If you want to diversify and you want to have secure supply, then trading with the US and trading with Europe may be in relative terms the safest bet. And my question is simply also against that, what you said, there will not be so much change necessarily with, say, if there were another Trump administration. My question is this a more generally held view in the US? And could one expect that indeed there would not be another time the kind of confrontation also in trade policy between the US and Europe as it was before, just because geopolitics has changed? Because that would be pretty much an upside if that were true. And would facilitate some of the initiatives, and would also allow to at least maybe have in selective areas indeed continue with cooperation.
All right, we have time for questions.
Yeah, a couple of points on Richard. All central banks will only act after the legislature will have provided legislation. Ultimately, we are talking about currency, and currency is a key component of sovereignty. So eventually politicians will have to have their say. Central banks are only those who will implement what governments and parliaments will have approved. That's true in the EU. That's true in the UK. And of course, it's going to be true in the US. So it's not a question whether the Fed should wait for Congress to do something. The Fed should do what's necessary to be on the forefront of innovation, including on CBDCs, because CBDCs for China is a massive geopolitical project that goes together with the Belt and Road Initiative, that goes together with the Digital Silk Road, goes together with many other initiatives they have. And I agree with Rolf. I mean, EU and US should act as part of the same Western alliance, let's call it that way, right? In fact, the problem of Trump is that it put a wedge within the alliance and make it extremely hard for the Europeans to fully embrace the alliance. And there's a recurrent discussion about establishing strategic autonomy, which effectively means we may need to go our own way. But with global geopolitics going the way we have been discussing, it's very hard for the US and EU to go separate ways. Is actually not a good outcome. But then if you have more isolationist positions from the US, it's going to be very hard for the Europeans not to think in terms of strategic autonomy.
Very good. We are just about to finish. You can do one more question, but I suggest that we actually conclude the formal part because some people have to run to the center, currently the center of the universe, namely Washington, D.C. The others can stay, have some more coffee, and enjoy further informal talks. So thank you all very much.